What if I told you that every major recession indicator that's ever predicted an economic collapse is flashing red right now? And what if the very people who are supposed to warn us about these things are staying eerily quiet? History doesn't just repeat itself, it screams warnings at us. And right now, it's screaming louder than it has in decades. The question isn't whether a recession is coming. The question is whether you'll be one of the people who saw it coming and protected yourself, or one of the millions who wake up one morning to find their retirement savings cut in half. Let me show you something that should terrify every American with money in the stock market right now. There's an indicator called the Somm rule. It's named after economist Claudia Somm, and it has a perfect track record. Not good, not great, perfect. Every single time this indicator has triggered since the late 50s, a recession has followed within months, not years, months. And right now, as we speak, that indicator is sitting at levels we haven't seen since the financial crisis. But here's what's really disturbing. The mainstream media isn't talking about it. Your financial advisor probably hasn't mentioned it. And the Federal Reserve is acting like everything is fine while they're quietly preparing for something very different. The Somm rule works by measuring the 3-month moving average of the unemployment rate against its low point over the previous 12 months. When that difference hits 0.5% or higher, the recession alarm goes off. And we're not just approaching that threshold. We've crossed it. We're in the danger zone. But that's just one indicator, right? Maybe it's a false alarm this time. Except it's not alone. Not even close. The yield curve, which inverted over a year ago, is another perfect predictor. When short-term interest rates rise above long-term rates, it means bond investors see trouble ahead. They're willing to accept lower returns on long-term bonds because they think the economy is going to tank and interest rates will have to come down to save it. That inversion has preceded every recession for the past 50 years, every single one. And then there's the Conference Board's leading economic index. This thing tracks 10 different economic indicators, everything from building permits to stock prices to consumer expectations. It's designed to predict where the economy is headed 3 to 6 months out. And it's been declining for months in a row now. Not just declining, plummeting. The kind of decline that historically shows up right before the economy falls off a cliff. But wait, the stock market is still near all-time highs, you might be thinking. Doesn't that mean everything is fine? That's exactly what they said in 2007. The S&P 500 hit its peak in October of that year. By March 2009, it had lost more than half its value, 57% gone. If you had $1 million in your retirement account, you watched it turn into $430,000. And here's the thing that nobody tells you about those crashes. The market doesn't warn you. It doesn't send you a letter saying, hey, you might want to get out now. It just drops. Fast, brutal, unforgiving. Before we go any further, I want to make sure you're getting the full picture here. I've put together a free guide that breaks down the exact strategies thousands of American retirees are using right now to protect their wealth from what's coming. It's in the description below. No cost, no obligation, just the information you need to make informed decisions about your financial future. Grab it while you're thinking about it, because what I'm about to show you next is going to make it very clear why this matters so much right now. Let's talk about what's actually happening in the economy right now, beneath all the headlines and the political spin. Consumer spending, which makes up about 70% of the US economy, is starting to crack. Credit card debt just hit record highs. We're talking over $1 trillion in revolving credit card debt. People aren't spending because they have money. They're spending because they're desperate to maintain their lifestyle while their real purchasing power evaporates. And those credit cards? The interest rates on them are brutal right now. We're seeing average APRs above 20%. That means people are paying 20 cents on every dollar just to service their debt. That's not sustainable. That's a ticking time bomb. Meanwhile, the savings rate has collapsed. Americans are saving less than 4% of their disposable income. During healthy economic times, that number is usually closer to 8 or 10%. During the pandemic, when people were scared and uncertain, it shot up to 33%. Now it's back down to levels we haven't seen since right before the 2008 crisis. People are living paycheck to paycheck, burning through whatever cushion they had, and hoping nothing goes wrong. But something always goes wrong. That's how recessions work. They find the weakest link in the chain, and they pull until everything breaks. And speaking of weak links, let's talk about the commercial real estate market. This is the crisis that nobody's talking about, but it's going to be massive. Office buildings in major cities are sitting half empty because of remote work. Retail spaces are getting crushed by online shopping. And all of these properties were financed with cheap debt that's now coming due at much higher interest rates. The owners can't refinance because the properties aren't worth what they were when they took out the original loans. So what happens? Defaults, foreclosures, banks taking massive losses, and who holds a lot of that commercial real estate debt? Regional banks. The same regional banks that were already struggling earlier this year. Remember Silicon Valley Bank? That was just the beginning. Here's where it gets really interesting, and by interesting I mean terrifying. The Federal Reserve has been raising interest rates faster than they have in 40 years, trying to fight inflation. And yes, inflation has come down from its peak, but it's still running well above their 2% target, so they're stuck. If they keep rates high, they choke off economic growth and push us into recession. If they cut rates too soon, inflation roars back and they lose all credibility. Either way, we're headed for pain. The only question is what kind of pain and how much. Now let me show you what the smart money is doing while all of this is happening. Central banks around the world have been buying gold at a pace we haven't seen in decades. The World Gold Council reported that central banks added hundreds of tons of gold to their reserves in recent quarters. These aren't small countries hedging their bets. We're talking about China, Russia, India, Turkey, major economic powers that are actively diversifying away from dollar-denominated assets. Why? Because they see the same warning signs we're looking at. They understand that when the next crisis hits, the Federal Reserve is going to do what it always does. Print money, lots of it. And when they do that, the value of every dollar you own goes down. Think about what happened during the financial crisis. The Fed's balance sheet went from under $1 trillion to over $4 trillion in just a few years. They called it quantitative easing. What it really was creating money out of thin air to buy government bonds and mortgage-backed securities. And it worked, in the sense that it prevented a complete collapse of the financial system. But it also set the stage for the inflation we're dealing with now. Because all that money didn't just disappear. It's still out there, sloshing around in the economy, driving up prices on everything from houses to groceries to healthcare. And here's the part that should really concern you. The Fed's balance sheet is still massive. They've barely begun to unwind all the stimulus they pumped into the system, which means when the next crisis hits, and it will hit, they're going to have to get even more creative. More money printing, more intervention, more devaluation of the currency you're holding in your bank account and your retirement funds. This isn't conspiracy theory stuff. This is just how the system works. They've told us this is what they'll do. They've done it before. They'll do it again. Let me paint you a picture of what this looks like in real terms. Imagine you're 62 years old. You've worked your entire life. You've saved diligently. You've got $800,000 in your 401k, mostly in stock index funds, because that's what everyone said was the safe, smart play. You're planning to retire in 3 years. Then the recession hits. The market drops 40% in 6 months. Your $800,000 is now $480,000. But it gets worse. Because you're not working anymore, you can't just wait it out. You need that money to live on. So you're forced to sell at the bottom, locking in those losses. And even if the market eventually recovers, you won't be there to benefit from it. You'll be living on a fraction of what you planned, watching your dreams of a comfortable retirement slip away. That's not a hypothetical scenario. That's what happened to millions of Americans in 2008. And it's what's about to happen again to anyone who isn't paying attention to these warning signs. The difference this time is that we have even more debt, even more leverage, even more risk built into the system. The fall is going to be harder. The recovery is going to be slower. And the people who get hurt the worst are going to be the ones who trusted that everything would be fine because that's what they were told. Now, I know what some of you are thinking. This sounds like fear-mongering. This sounds like someone trying to scare you into making rash decisions. But let me ask you something. If your smoke detector went off in the middle of the night, would you ignore it because you didn't want to be scared? Or would you get up and check to make sure your house wasn't on fire? These recession indicators are your economic smoke detectors. And they're all going off at once. You can choose to ignore them, or you can choose to take action. Let's talk about what action actually looks like. Because this isn't about selling everything and hiding cash under your mattress. That's not a strategy. That's panic. What we're talking about is strategic diversification into assets that have historically held their value or even increased in value during economic turmoil. And at the top of that list, for thousands of years of human history, has been gold. Not because it's magical, not because it pays dividends or generates cash flow, but because it's the one asset that governments can't print more of. It's the one asset that maintains its purchasing power when everything else is falling apart. Look at what happened to gold during the last major recession. In 2008, when the stock market was cratering, gold actually went up. While people were watching their retirement accounts get cut in half, gold investors were seeing their holdings increase in value. And then, as the Federal Reserve started printing money to bail out the banks, gold really took off. It went from around $800 an ounce in late 2008 to over $1,900 an ounce by 2011. That's more than a 100% gain, while stocks were still trying to recover from their losses. But here's what's even more important than the price appreciation. Gold gave people options. When you own physical gold, you own something that has value anywhere in the world, in any economic condition. You're not dependent on a bank staying solvent. You're not dependent on a government honoring its promises. You're not dependent on a company's earnings report or a CEO's decisions. You own a tangible asset that has been recognized as valuable for 5,000 years. That's not speculation. That's insurance. And speaking of insurance, if you're sitting on $100,000 or more in retirement accounts right now, you need to understand something critical. There's a way to get physical gold into your retirement account without triggering taxes or penalties. It's called a gold IRA, and it's one of the most powerful wealth protection tools available to American retirees. I've put together a comprehensive guide on exactly how this works, what the rules are, and how to do it correctly. It's in the description below. This isn't about abandoning your retirement strategy. This is about adding a layer of protection that could make the difference between retiring comfortably and working into your 70s, because your nest egg got wiped out. Worth checking out if you're serious about protecting what you've worked so hard to build. Now let's get back to the bigger picture, because there's another factor at play here that most people aren't even aware of. The global monetary system is going through a fundamental shift right now. For the past 50 years, since Nixon took us off the gold standard, the US dollar has been the world's reserve currency. That meant that international trade was conducted in dollars. Countries held dollars as their primary reserve asset, and the United States got to print the world's money, which is an enormous advantage. But that system is breaking down. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems that bypass the dollar. Saudi Arabia, which has priced oil in dollars for decades, is now accepting yuan for Chinese oil purchases. This is a massive shift. What does this mean for you? It means that the demand for dollars is going to decrease. And when demand for something decreases while the supply keeps increasing, the value goes down. Your dollars will buy less. Your savings will be worth less. Your retirement income will cover fewer expenses. This isn't happening overnight. It's a gradual process, but it's accelerating. And the smart money, the central banks, the billionaires, the institutional investors, they're already positioning themselves for this new reality. They're buying gold, they're buying hard assets, they're getting out of pure dollar exposure. Let me give you a specific example of how this plays out. China has been accumulating gold for years. They don't announce every purchase. They don't tell the world exactly how much they have. But analysts estimate that China's gold reserves are significantly higher than what they officially report. Why would they do this? Because they're preparing for a world where the dollar is no longer dominant. They're building a foundation of hard assets that will support their currency and their economy when the current system breaks down. And if you think the Chinese government is doing this without good reason, you're not paying attention to how geopolitics works. Russia did the same thing before they were hit with sanctions. They massively increased their gold reserves and reduced their dollar holdings. When the sanctions came, they had a cushion. They had assets that couldn't be frozen by Western banks. They had real wealth that maintained its value regardless of what the US government decided to do. Now, I'm not saying you need to prepare for sanctions, but I am saying that the principle is the same. When you own gold, you own something that's outside the traditional financial system. You own something that can't be devalued by a central bank's printing press. You own something that has intrinsic value. And let's talk about that intrinsic value for a moment, because this is where gold really separates itself from paper assets. A stock is worth something. because people believe the company will generate future profits. A bond is worth something because people believe the borrower will pay them back with interest. A dollar is worth something because people believe the government will maintain its value. All of these things are based on belief, on trust, on promises. Gold is different. Gold is valuable because it's rare, because it's useful, because it's beautiful, because it's been valued by every civilization in human history. That value doesn't depend on anyone's promise. It doesn't depend on a government's fiscal responsibility. It doesn't depend on a company's quarterly earnings. It just is. Now, some people will tell you that gold doesn't generate income. It doesn't pay dividends. It just sits there. And that's true, but that's also missing the point. Gold isn't supposed to make you rich. Gold is supposed to keep you from becoming poor. It's supposed to preserve your wealth when everything else is losing value. Think of it like this. If you have $100,000 in the bank and inflation runs at 10% for 3 years, you've lost almost 30% of your purchasing power. Your $100,000 now buys what $70,000 would have bought 3 years ago. But if you had put that $100,000 into gold, and gold increased in value along with inflation, you've maintained your purchasing power. You can still buy the same amount of goods and services. That's the whole point. And here's where it gets really interesting. We're not just looking at normal inflation. We're looking at the potential for a currency crisis. When governments get desperate, when they've borrowed too much and promised too much and can't possibly deliver on all their obligations, they have two choices. They can default, which is politically unacceptable and economically catastrophic. Or they can inflate, which is politically easier and economically catastrophic in a different way. They always choose inflation. Always. Because it's a hidden tax that most people don't understand until it's too late. Look at what happened in Weimar Germany in the 1920s. The government printed so much money to pay its debts that the currency became worthless. People were using wheelbarrows full of cash to buy a loaf of bread. Life savings were wiped out overnight. The middle class was destroyed, and the people who survived with their wealth intact were the ones who owned hard assets: gold, silver, real estate, anything that couldn't be printed into oblivion. We're not at that point yet. But the trajectory is concerning. The debt levels are unprecedented. The political will to make hard choices is non-existent. And the printing presses are ready to go the moment the next crisis hits. Let me bring this back to something more immediate and concrete. The recession indicators we talked about at the beginning, they're not just abstract economic data. They represent real pain for real people. When unemployment rises, that's your neighbor losing their job. When consumer spending falls, that's families cutting back on necessities. When the stock market crashes, that's retirement dreams being shattered. And when the government responds by printing money, that's everyone's savings being quietly stolen through inflation. This is the cycle we're trapped in, and the only way to break free is to own assets that exist outside this cycle. Gold has been that asset for thousands of years. It was valuable when the Roman Empire was at its peak. It was valuable when the Roman Empire collapsed. It was valuable during the Renaissance. It was valuable during the Industrial Revolution. It was valuable during the Great Depression. It was valuable during World War II. It was valuable during the stagflation of the 1970s. It was valuable during the dot-com crash. It was valuable during the financial crisis. And it's valuable today. That track record isn't an accident. It's a fundamental property of an asset that can't be created out of thin air, that has real uses, and that people universally recognize as valuable. Now, I want to address something that comes up a lot when people talk about gold. They say, well, you can't eat gold. If things really fall apart, you'll want food and water and ammunition, not shiny metal. And you know what? They're partially right. If we're talking about a complete societal collapse, a Mad Max scenario, then yes, you're going to want practical survival supplies. But that's not what we're talking about here. We're talking about an economic recession, possibly a severe one. We're talking about a currency crisis, possibly a significant one. We're not talking about the end of civilization. We're talking about a period of economic turmoil, where having real assets instead of paper promises is going to make a massive difference in your quality of life. And even in the worst case scenarios, gold has always been the bridge currency. It's what people use to trade when the official currency has failed. It's what refugees use to carry their wealth across borders. It's what black markets accept when nothing else has value. So even in the extreme scenarios, gold isn't useless. It's actually more useful than almost anything else except immediate survival necessities. But again, we're not preparing for the apocalypse. We're preparing for an economic downturn that all the historical indicators say is coming. Let's talk about timing for a moment, because that's what everyone wants to know. When is this recession going to hit? How much time do we have? And the honest answer is, nobody knows exactly. The indicators tell us we're in the danger zone. They tell us the risk is extremely high. But they can't tell us whether it's going to be next month or 6 months from now or a year from now. What they can tell us is that when it does hit, it's going to happen fast. Recessions don't announce themselves with a press release. They show up in the unemployment numbers. They show up in the GDP reports. They show up in your portfolio statement. And by the time you see them there, it's too late to prepare. That's why the time to act is now, while things still seem relatively normal, while you can still make rational decisions without panic, while you can still move assets around without everyone else trying to do the same thing at the same time. Because when the crisis hits, when everyone suddenly realizes that the emperor has no clothes, that's when the rush for the exits begins. That's when gold dealers run out of inventory. That's when premiums skyrocket. That's when you can't get your money out of your brokerage account because the systems are overwhelmed. That's when you wish you had prepared when you had the chance. I've seen this pattern play out multiple times in my career. 2008 was a perfect example. In the months leading up to the crisis, there were warning signs everywhere. The housing market was clearly in trouble. The banks were clearly over-leveraged. The derivatives market was clearly a ticking time bomb. But most people ignored it because things still seemed okay on the surface. The stock market was still near its highs. Unemployment was still relatively low. The economy was still growing, albeit slowly. And then, almost overnight, everything changed. Lehman Brothers collapsed, the credit markets froze, the stock market went into free fall, and suddenly everyone wanted to get to safety at the same time. The people who prepared in advance, who had already moved some of their wealth into gold and other hard assets, they were fine. Stressed, sure. Concerned about the future, absolutely. But financially secure. They had a cushion. They had options. They could ride out the storm without being forced to sell at the bottom. The people who waited until the crisis was obvious, they got crushed. They sold their stocks at massive losses. They couldn't get into gold because the premiums were through the roof and the dealers were sold out. They watched their retirement accounts evaporate, and there was nothing they could do about it. Which group do you want to be in? Because that's the choice you're making right now, whether you realize it or not. Every day you wait is a day closer to the next crisis. Every day you keep all your wealth in paper assets is a day you're exposed to the risk of those assets losing significant value. And every day you tell yourself that everything will be fine, that the government will fix it, that your financial advisor has it under control, is a day you're trusting in a system that has failed repeatedly throughout history. Let me share one more historical parallel that I think is particularly relevant right now. In the 1970s, the United States faced a crisis that nobody thought was possible. We had high inflation and high unemployment at the same time, something that wasn't supposed to happen according to the economic theories of the day. They called it stagflation. The stock market went nowhere for a decade. Bonds got crushed by inflation. Real estate was hit or missed depending on your location. But gold? Gold went from $35 an ounce in 1970 to over $800 an ounce by 1980. That's more than a 20-fold increase. People who owned gold during that period didn't just preserve their wealth. They multiplied it. And here's what's scary. The conditions we're facing now are in many ways worse than what we faced in the 70s. The debt levels are higher.